Well, not everyone is bullish on the U.S. economy. Vanguard, one of the biggest names in investing, is predicting a 50% chance that stocks tumble into correction territory this year. Let's bring in Vanguard Global Chief Economist Joe Davis. Joe, good to have you on the show. Thanks for stopping by.
Thanks for having me.
Before we dig in there, I just want to get your reaction to today's jobs report.
Pretty much as expected. I mean, we're not expecting a significant acceleration in the U.S. economy this year. Now, we are not anticipating a recession. So I think the numbers we saw today are pretty much in line with what I think investors should anticipate over the coming year. Positive job growth, but we're still going to see modest deceleration in the U.S. economy as we go into the second half.
I appreciate your contrarian take, and I very much like it. Really, some great notes here. What don't you like about this market right now?
Well, I just think that the fact that the price appreciation is just moving well above fundamentals. So again, at Vanguard, we have a long-term orientation. We still believe stocks will outperform bonds over the next several years, but I think we also have to have reasonable expectations. And I think we're continuing to see a disconnect. Prices continue to exceed fundamentals, and that's the reason why we should just be prepared for some downside risk to the equity markets at some point this year.
If a correction is coming, as you say it probably will be this year, what sectors can investors be in to sort of mitigate the damage for themselves?
Sure. Well, I think first is to stick to the plan. I mean, one of our biggest counsels to advisors and to investors this year is to not get over your skis, right? And to not take on undue risk, particularly given the strong performance we've seen over the past 3 or 4 years. So that's fantastic news. What you tend to see at times, though, is investors at this point in time starting to take on undue risk. And so I think we're having more modest expectations. If you are an active investor, perhaps parts of the market that are more value-oriented, that have not participated as strongly as some of the growth sectors and the tech sectors.
When you talk to clients right now, do you get the sense, and I can't think of a better term, that they are foaming at the mouth to get into this market? That type of euphoria, which ultimately leads to maybe a contrarian take.
It's a really good point, although it's not as euphoric as, say, the late 90s. Mm-hmm. You know, I mean, when we saw that, you even
it's probably
saw,
a good thing.
Which is a good thing, and that would be a positive upside risk to some that are a little bit more bullish on the financial markets. You know, in the late 90s, we saw cash flows going into anything that began with E for equity. Here, it's a little bit more balanced cash flows across the mutual fund and ETF space. And so in that sense, that's one positive factor.
People are being a little more choosy this time because there's a lot of cash still on the sidelines. For whatever we want to say about this market hitting record after record, there's still a lot of money on the sidelines.
Yes. And I think the biggest thing is to stay invested, stick to the plan, because if we are talking about a lower return environment, we certainly didn't have it last year, but the math pretty much dictates over the next several years, not negative, but lower than historical average. That tells me as investors, you have to stay dedicated to the plan. And then again, just be mindful of what sort of risk you want to take on in the next few years.
Given how quickly and sharply we have advanced in the markets, is your correction maybe something more like a quick bear market where we can lose 10 to 20% in a month?
Well, and again, listen, I'm personally not hoping for a correction.
Absolutely.
It's just when you do, and it's pretty simple. I mean, when you have valuations that are well above historical averages, and you have a stock market that tends to be volatile from year to year, that's why we have an elevated odds of a correction. But we do not see a bear market because that would be associated with a recession. And our odds of recession are not zero, but they're not at that 50% level that you mentioned. So I would hope that should we have one, it would be short-lived and that the markets would bounce back, similar to what we saw in early 2018 and the early part, towards the end of 2018, where we saw that rapid fall. But actually, many investors, if they stick to the plan, then they saw the gain quickly there.
So you're looking at more like a 10% sell-off, like a good old-fashioned correction.
Yeah, which is actually natural. I think what's actually somewhat unnatural about these markets is the very low persistent volatility we've seen. And so that actually would be a little bit healthier, I think, for the financial market.
If we saw more volatility.
More volatility, because that would also mean that there would be a higher expected risk premium or return for equities over a longer period of time, which sounds somewhat contrarian, but I think that would be actually a little welcome development.
And before I let you go, political risk. I can't think of a better person to ask than you. Political risk, how are you thinking about it in the portfolio?
Well, we track policy uncertainty. We believe that it's structurally or more secularly going to remain elevated. I think that's where you have to think about diversification. And there, I think you should look more so outside of equity into fixed income. So despite the low level of interest rates, should we have a correction this year in the U.S. equity market, I can tell you one area of the market that probably will rally, and that's the fixed income market, high quality. And so I think thinking about that in the role of bonds, despite the low yields, can still provide some ballast going forward.
All right, Joe Davis, really good thoughts. Thanks for coming.
Thank you.
Thank you for having me.